Hello, and thank you for joining our webinar today. I want to welcome everyone to our presentation, Tax Cut and Jobs Act for Real Estate, What Real Estate Owners Need to Know for 2018 and Beyond. This is part 3 in our 4-part series. If you missed part 1 on the individual tax changes or part 2 on business changes, you are invited to visit our website, www.rcthornton.com, and watch the recordings from our speaker series page. This webinar will also be posted to our website within 24 hours of this presentation. We have one more webinar coming up in this series. The next one will be this Thursday, January 25th, for professional practices. If you would like to sponsor one of these webinars at no cost for your colleagues or your trade association, please call our office for details. It is free, and we would love to work with you on your specific topic of interest for your business. Our webinar today is presented by Chuck Thornton of R.C. Thornton and Associates. Chuck is a CPA who specializes in tax planning, compliance, and tax representation before governmental authorities. Chuck has lectured locally and nationally on topics such as tax law, management, business valuation, and strategic tax planning. Both the American Institute of Certified Public Accountants and the Arizona Society of Certified Public Accountants have honored Chuck as the Speaker of the Year. If you have any questions during this presentation, please email them to Chuck at chuck@rcthornton.com. If they are not answered at the end of the presentation, he will get back to you via email. So without further delay, let me present Chuck Thornton.
Well, thank you, and good morning to all you guys out there who own real estate, because this section is going to be for you. In fact, I've kind of glancing through the people who've been listening in, and we have quite a few repeaters. So thank you for hanging in there with us. By the way, there's always this copyright notice. Let's just kind of go through it. You're certainly free to use these materials for yourself, and you can certainly give copies to your friends, but they're not really for commercial use, meaning that they're not for some publication to start publishing this. I've been following this law ever since almost inception. I don't usually do that with these tax laws because they go through so many iterations. You get kind of confused as to what the final product is, but this was important enough. This is a kind of a major change on everything that I thought it was important to be able to do that. Now, as I start writing these materials, going a little time back, more editorial commentary has now started to come out. So I'm starting to look at that also. I had warned previous people, I said, if you read these things on the internet, some of it's correct, some of it's not. It's usually reporters writing things and they have their own interpretations, but there's going to be some good editorial comments at this point. So let's go ahead and get started. And let's, by the way, some of you readers out there probably just had the paper copies. So to help you out, I'll say what page number we're going to next so you'll be aware of it. So this will go to page 4. Okay, major points we're going to discuss. We're going to talk about the new 20% pass-through deductions for the people who listened in on our business portion. Some of these slides, some of my commentaries are the same, but I'm going to expand it more into the real estate, and I need to go through the basics just to make sure that people were not on our prior ones are in step with us. Considering cost segregation, I'm a big fan of cost segregation. Most of our clients already know that, and so we have some commentary on that. So I just got a message just said we're just all in listen mode right now. So here's the major points we're going to discuss. And we talked about 20% pass-through, considering cost segregation, interest paid limitations. There's some depreciation changes. There's some limitations on losses. And I failed to put on the slides something about tax-free exchanges. So I don't forget it. Let's just keep on the slide right now, and let's just do tax-free exchanges right now. It used to be that for real estate property, you could exchange property, which is real estate for real estate. It could be any grade of real estate. It could have been an office building being exchanged for raw land, and that portion has not changed. The portion that has changed is you could have in the past done tax-free exchanges for tangible personal property. Now, notice that word tangible personal property, so that's non-real estate. You could have done exchange for similar or like kind. So you could have taken a grader for a construction company and traded it in for another grader. They may have given you a $40,000 credit. At this point, you are unable to do tax-free exchanges for tangible personal property. I had to break news to a contractor client yesterday who had traded in at the beginning of the year, unfortunately, almost the day that January 2nd opened, he had traded in 5 different vehicles, heavy equipment, gotten quite a bit of credit for it, and there's no tax-free exchanges. Some people have suggested, it's an idea to consider, that if you do have tangible personal property, that maybe you might want to traded in and have leased property in the past. You have to work through the issues of whether you think leasing versus purchase is better, but an answer to that is converting your tangible personal property into property that's leased. So in effect, what happens is you just simply get reduced lease payments, but you don't get a big amount of income. This tangible personal property limitations can also have something to do with issues where we have cost segregation, which we will talk about a little bit more. So, slide 5, please. Okay, the big one is, and some of you will recognize the slide, it's the big 20% pass-through deduction for qualified business income of pass-through entities, which could be, by the way, it could be a partnership, it could be a proprietorship, it could be a Schedule E, it could be an S corporation. Basically, it's the one that says that if you have qualified income, you can get a phantom deduction for it. Now, obviously, this is about real estate, so you're going to discover in a moment this applies to real estate also, but just as generic, this discussion here, if your qualified business income is $100,000, you get a deduction of $20,000. And if your tax bracket is, I think this was at 33%, you'll save $6,600. So that's just if you had to say, how does the 20% work in general? It's almost the same as the taxable income from these entities, not a totally true statement, but almost like that. It's from the trade or business income, and you just get a phantom 20% deduction. Now, there's basis issues and things that we won't get into, but it's not as easy as that. If that was it, we'd probably be done with our seminar at this point. So let's go over to slide 6, please. Now, qualified business income is a new term in the code. And by the way, as we talked in prior presentations, all this stuff's supposed to sunset in January of 2026, it is. So this is because of that budget reconciliation things that they went through. And so this law may not be in place after 2026. If the Democrats happen to take control of everything, it might be gone even sooner, to tell you the truth. Or it may become a permanent fixture. You just don't know. Anyway, it means income from any trade or business, which I'm going to talk about what you mean by trade or business, other than a specified service trade or business, or your W-2 doesn't count either. Now, the reason I mention the specified service trade or business is doctors, lawyers, that kind of stuff, accountants, people providing services. Their income within certain income level ranges are not subject to this 20% number. Now, Thursday is reserved for our doctors and people with service trades or businesses. So if you happen to be in that category, that's when you're going to want to listen to. So I'm not talking about these guys anymore on this particular presentation. I just bring it up to kind of put it in some type of context. What components are not part of QBI? Must be associated with conduct, trade, or business. That effectively knocks out investment income. It doesn't include the W-2, which was reported before. It doesn't include guaranteed payments from a partnership. Neither of those are going to be a big issue with real estate, though. Okay, slide 7. Okay, I keep on going on about the personal service corporations and businesses, and it does exclude, by the way, engineers and architects. Somehow, I guess they lobbied pretty well. So while all the health law, accounting, actuarial service, and all those things, engineers and architects who really do kind of tie into real estate related businesses. They are exempted from that provision. So they don't really need to listen to the presentation on Thursday if you're that category. Okay, slide 8, please. Slide 8, there we go, thank you. Okay, is investment in real estate a trade or business? Now, this is where I want to start getting our first pointer out here. It says a statute does not do anything that excludes real estate. There are some other areas of the law that excludes real estate for Social Security income. You don't pay self-employment tax on real estate earnings, as an example. But there's nothing that really says what a trade or business is. Over the years, it's been cases and things like that have come up. People have had hobbies. They're trying to take the deduction for their losses. And they said, well, did you really intend to be in a trade or business? The general definition would include, if one spent time looking through all these cases and regulations, it's a consideration of time, energy, continuity, involvement in the business, like in the case of your real estate operations or any other type of business. So it anticipates some energy, time that's going to go into some supervision. I could almost make up a list of things, but it's not if it's just a basic triple net lease. Now, most commentators seem to agree, and so far I do too, that triple net leases, particular real estate, probably would not be a trade or business. Why? You have a piece of property, you're basically loaning it if you want to call it that. You're letting them use it, but the person who takes over the real estate is the person who pays the property taxes, insurance, maintenance, those types of things. So in reality, it's almost like you just have an investment. And you may recall earlier that the investment piece of this would not be included, like stocks and dividends and interest and things like that. So most commentators would agree triple net leases probably won't apply. We do have clients that do have a triple net leases, quite a few, and we've done something called an aggregate election. Some of you may recognize that, where for purposes of passive losses, we aggregate that building with the property. That section of the law does not apply to this law here. So therefore, elections that have been made for passive activities does not undo the concept that a triple net lease probably would not be a trade or business. So this may be a caution that some people may want to consider redoing their leases. We're going to talk about that more. There's some other strategies in this also, but that's almost a non-starter right off the bat. So there's some things that we need to do about that. Slide 9. Okay, you could change triple leases into more of an operating leases where the owner of the real estate takes care of the maintenance, taxes, insurance. In effect, it effectively gets you to be a little bit more in business, and you may not want to do this. Or we have some clients who have already sold their businesses. They do have triple net leases to the buyer, and they are enjoying themselves. And as a practical matter, they're not going to go try to renegotiate their leases. So in effect, that's probably a non-starter for them also at the same time. If you're leasing to a business, you might consider doing that. But that's going to be kind of interesting, because then you get into financial statements and things like that. And the IRS could always try to take the point of view saying that, well, economically, you're really doing the same thing as before. And so you probably need to tie in some economic purpose to this. Here's another idea that we've recently come up with. If you're renting to your business, consider reducing the rent and leaving everything else the same, because you have to have basically a profit in your real estate. People who've had buildings for a while probably do have a profit in their real estate, and maybe you just simply delay paying the rent. You could accrue it. The interesting thing is rent that is paid to a business that you own more than 50% of, or to a real estate you own more than 50% of, you have to pay it to get the deduction. So if we just simply let's not pay it, that means the profit of your corporation is higher, and that means the rent of your real estate is less, thereby probably taking from a profit to a much lesser profit. And since you are not deducting the rent at the corporation level, then you could increase the QBI 20% deduction there. So if you're kind of following my logic, you might be able to play around with this by simply just not paying the rent. If you're not going to pay the rent, you probably ought to have a business reason for it, and you might have some agreement that says in lieu of paying the rent, they agree to, they being the real estate, your real estate entity agrees to basically forego some of the rent to be paid at a later date. And when might that later date be? Well, it might just happen to be January 1st, 2026, which is when all this is going to expire anyhow. So there's a couple things to play around with if you're going to be in this issue of a triple net lease and you have controls on both sides of the equation. For my clients who sold their businesses and they're enjoying the rent coming in from their buyer who's totally unrelated, you're not going to do anything of this type of things that we're talking about. You're not going to go to them and say, pay the rent later because you don't own the business at this point anyhow. Okay, slide 10. Okay, certain principles apply. Basically, I'm going to just delve into this a little bit more. QBI starts with taxable income. It excludes investment income, which I mentioned earlier. It's the deduction of 20% of domestic qualified income, meaning income from foreign sources is not subject to this. If you are renting your real estate to your business, so undoubtedly you're renting it here domestically, so you're still in the game for this. Now, by the way, once your income exceeds $415,000, deductions limit to something else. Now, by the way, the issue of the taxable income 415, it really starts, there's a phase out that goes from $315,000 to $415,000. So once your taxable income exceeds $415,000, there is another limitation on your deduction that is not just 20% taxable income. If you're under 315, there isn't, and if you're between 315 and 415, there's a phase out, and I'm not going to go through the calculations of the phase outs. Most people out there probably wouldn't be interested. That's more of an accountant's thing that's kind of fun to do. But once your taxable income exceeds $415,000, the deduction is further limited to the greater of 50% of the W-2 wages or 2.5% of the unadjusted basis of your property plus 25% of wages. So at this point, I hear a truck going by here. I wonder if they're going to get a deduction for that. But anyway, you're really now down to, if you're renting real estate, you most likely do not rent and have a staff. You're renting it to your own business. Some of you probably have it triple net leases. We're really boiling down to the limitation being 2.5% of your unadjusted basis, meaning we need to explore that a little bit more. And so let's go to slide 11. Okay, just to give a quick example though. Jack Files, married filing joint, has a Schedule C proprietorship taxable income from his business 150. His other income is $50,000. It's dividends and interest, things like that. His taxable income, taking the standard deduction, is 176. He is not a real estate, but I'll just show you very quickly one of these limitations. The deduction is 20% times his QBI income of 150. It's $30,000, but it's limited to 20% of his taxable income, which is 176. His taxable income limitation is 35.2, which is greater, so he gets a 30. But let's just pretend that that taxable income number was $100,000. Then his limit would have been $20,000 and his deduction would have been 20. So that's a taxable income limit. And let's look at slide 12. I think there might be one more example here. Yes, there is. So let's say in the prior example, the QBI income was $1 million. There's no other QBI income. His taxable income is $700,000. He has wages of $750,000. And the reason I'm bringing this in is I failed to mention his income, taxable income, is over there it is. It is over $415,000. And so his tentative deduction would be 20% times his million. That's $200,000. But limit now, it's based on taxable income. But another limitation is the greater of 50% of wages, 125, or 25% of wages plus 2.5. So therefore, the greater is 50% of wages, 125. So you may not be following this, but the issue of it is even though we have a taxable income limit, There is another one that is a limitation if your income's over 415, your taxable income, which is a practical matter for many clients who have series of businesses and have real estate. The limitation is probably almost ultimately going to boil down to what's 2.5% of the unadjusted basis of the assets. So I think if we go to 12 or 13, I'm sorry, just a few of the things it talks about, you can add it to the income. On the wages, I am going to suggest there could be a play here for the time that's being spent by some of the staff in your entities. Maybe you might want to do a common paymaster and have some wages on your rental properties. Now, I'll probably bring that up one more time, but if you're going to do that play, you have to make sure that they do get a W-2 from that entity that you're a common paymaster with, and is the filing is done 60 days after the due date, including extensions, meaning you be delinquent and found the payrolls up to 60 days. Now, common paymaster, this will be for a few of you, is that sometimes you have multiple entities and you don't want to have to put people on payroll multiple times, so you put them in one company and then you enter into a common paymaster agreement with the other entities that basically says that what we're doing is we are paying the payroll and the wages on behalf of that company. So there may be a play here if we need to bring in wages on some of this real estate, but again, I'll repeat, it's almost always going to be 2.5% of your adjusted basis of your property. And let's go to slide 14. Okay, now this is one that we did spend a little time on in our business section, our last presentation, I think it was last Thursday. And actually, I have a correction. It's a good correction. So for anyone who was listening in to that one, you may say, well, he said a little different than I did, but there's some more information that came out since then, and there's some more clarification. So I'm going to focus on qualified property. I keep on saying your limitations, you're going to go through the gauntlet of your 20% of your income from your rental properties. In this case, you're going to go through another limitation, 20% of your taxable income, and then you're going to go through another limitation that might ratchet it down, and that is if your taxable income is over 415, you're most likely going to use the qualified property, and that's that 2.5 number. So it says it's depreciable tangible property used to produce income subject to QBI. Well, tangible, that's real estate. You're renting the property, that's income. And there's nothing that says that rental is not QBI. I caution whether you have a triple net lease, though, you need to be concerned about that. The depreciation period cannot be before the end of the close of the taxable year. So all good depreciation comes to an end sooner or later. And if you're not depreciating the asset as of the end of the year, then you no longer can call that qualified property. Remember, qualified property is our base that we're going to apply our 2.5% against. The depreciable period begins, remember, our focus here is if the depreciation period has ended, then you can't take any more depreciation. And then it says, but the depreciable period says it begins when the property is placed in service, and it's a period that ends on the later of a date ending 10 years after the property was placed in service. So if I had tangible personal property and the life had been 5 years, I'm still going to get to use this into my qualified property base for 10 years. Or the last day of the full year in the applicable recovery period that would apply under the what's called makers depreciation without regard to the alternative depreciation. That's kind of accountanese there. What we're talking about is that could be your real estate. And you might have a residential property being depreciated over 27.5 years, commercial perhaps over 39 years. And what it basically says is that it's the latter of the date ending 10 years after property placed in service, okay, or the last day the full year applicable service would be applied under the makers. So it's the cost that you put in the property. It's not the depreciable basis. So that's good news. Let's look at slide 15. So residential property, I mentioned that, subject to 27.5 years. You can't take that into consideration after that. So if you're in the year 30 of this, you would not be able to use that base because the later of those two formulas was 27.5 years. So it's not 27.5 plus 10, that was one, or the later of the depreciable period. If you had non-residential property subject to depreciation of 39 years, then you could not take the cost consideration in year 42. So again, in a prior presentation, I had indicated 10 years was the cap, and it turns out that that's not correct. As I go back and read the code and read some commentaries, it's going to be both of them. So if you have real estate, the odds are, if it is commercial, I don't know of anyone who's had it over 39 years, to say the truth. As I think through the clientele, we do have some clients that may have residential that's been more than 27.5. Now, here's a couple caveats. So if I have this base, I'm going to use of unadjusted basis, meaning pretty much what I paid for it. Your cost segregation studies, I want to mention that because a lot of our clients out there have that. Your cost segregation studies may do a little damage to this, to tell you the truth, after a 10-year period of time. I would not be inspired not to do cost segregation. It's just a consideration for us to have, because to the extent cost segregations will take your real estate, by the way, and it'll break into different segments. And it might say the carpeting has a 5-year life and something else has a life that's less than what normal real estate would be. And you basically get to write off a lot quicker. We do this all the time with clients. It's just that when we march down the road, the portion that we wrote off quicker due to cost segregation, that portion may have a fuse of only 10 years, whereas the rest of the core building would be 39 years. Other treatments such as qualified restaurant property, qualified retail improvements may do the same thing too. The rules have changed on this, by the way, but had you been taking depreciation on property that was a qualified retail improvement property, it was 15-year property, you could take bonus depreciation, we'll get into that. But if the real estate period was 15 years, that would get you up to 25 years. You still might be as shy of that 39 years if you had the building that long. Most people, when they make the improvements, they're probably going to replace those improvements in a reasonable period of time. Like franchisees are required often to change the build outs for their improvements as a condition of re-upping on their franchise agreement. Okay, 16. Okay, bring this together for the real estate owner. If your real estate is a separate operating entity, consider if there's a triple lease. I'm summarizing this. Triple lease probably doesn't work. You might want to either rewrite them, or if you really don't want to go through a lot of work on this, maybe we just consider giving up on the 20% QBI in the real estate operations, and we let it increase in our regular operations if the economics works out, and maybe we get the same result just by simply delaying paying the rent. You'll probably have no W-2 wages in these operations unless they're extensive. We have some clients that have multiple buildings, multiple locations. Being a triple net lease, staff probably are taking care of the maintenance and upkeep. Maybe it's worthwhile now to have a W-2 payroll on some of these properties instead of having the lessee doing the repairs. And that's why I say consider the common paymaster. But the safest thing is just to assume, for at least right now, that you're working on 2.5% and that you're probably still in the time limit. So you're probably still in the game. It's just a question of how much you would be in the game. Okay, slide 17. Now, as an example, let's say that your QBI for rentals is $200,000 without any limitations that we've been talking about, okay? And you normally would then say, I have a $40,000 deduction. You have no wages, but you have a building cost, not including land. I just threw these numbers up here. $3,000 about 10 years ago. Clearly, we're within the time limit. We multiply 2.5% times $3 million, we get $75,000. My limit is 75, but I was only gonna get 40 anyhow. So you can play around with that number, but let's say that QBI deduction was $82,000. If my limit was 75, that would have been the max. So again, questions, thoughts, What would happen if you reduce rents? What caveats should you consider? It's an untested tool, to tell you the truth, and might the IRS get into a substance versus form? So I think documentation and some logic in why you're doing that. For instance, maybe you'll get more rent later on, maybe you'll get some interest, whatever, but just not just unilaterally say we're just not going to pay it. That would be keeping the lease the same but not paying the rent was the other one. Triple net lease, you just might simply want to change the terms of those triple net leases if you control both sides of the equation. You're effectively control the lessor and the lessee. Okay, 17, please. Okay, by the way, what happens if you have excess QBI? It gets carried forward to the next period to offset QBI. And for regular taxes, if it's not passive, you can deduct this to the extent of limitations on NOL. So this, by the way, this whole exercise doesn't do away with traditional discussions on basis and at risk and passive rules. It's just another layer. I know that our president talked about making tax laws simpler, and perhaps on the actual individual return, perhaps that's true for some people, but this is a Rubik's Cube trying to figure out mathematically the best way of doing this. Unfortunately for us, we already have the tax software in our system that allows us to roll these things forward and already start doing the computations for 2018. And that's important for our clients, but whether you're a client or not, it's important to start visiting with your advisors, not like you normally do, like in September or October, and say, well, what do we do? You need to be visiting with them, quite frankly, now, probably May at the latest. For instance, if you just wanted to implement not paying the rent and you want to come up with the documentation and you wait till this October to make that decision, you've already paid the rent for 10 months. How are you going to undo that? So you want to be more prospective. If you want to kind of jerry rig some common paymaster with wages into the larger multiple entities, you need to get that early in the game. You can't wait till October to do these things. If you're going to redo your leases, if you do them in October, that redoing of the triple net lease is only good for 2 months. It's not 12 months worth of income. So you can see making decisions with your advisor on what you're going to do. And I realize it's tax season. I'm a CPA, busy at tax season. We will be approaching some of our clients. We'll probably be done with this exercise in May. But again, I always suggest that you visit with your CPA and get some calculations done because there's money on the table. I've never told clients that before. I never said, let's start planning for next year's taxes or even this year's taxes so early in the year. Okay, next slide, please. I think we're on 19. Okay, cost studies, segregation strategies. I mentioned cost segregation. We've used it for years. What cost segregation is, it's basically taking a piece of property. Maybe it's, $2,000 you paid for it, you back out land. And as you think through the building, there are components in there that for tax law purposes are actually personal tangible property. For local law purposes, perhaps not, okay? But for tax purposes, they look for whether it's inherently a permanent structure, whether it's part of the manufacturing process or production process. So dentists, as an example, who do improvements in buildings, a lot of their plumbing and the electrical components and things that run the x-ray machines and things are part of their production process that they haven't thought of themselves being producers. They kind of are. And there are people out there, and we refer them in, that do cost seg studies that'll give you a report. The IRS has come out with rules on how to do all this stuff, but it's been around. This rule's been around since, I guess, the turn of 2000, 2001, and more of our clients are doing that. Now, if you have a building, and this would be anyone, and some of our clients, we're pretty much kind of going through and getting the final people to do these cost seg studies in 2017, not 2018. Why would I do that? I might be able to take a building that cost $1 million. I might be able to get 250,000 of it allocated, and I might be able to get a full deduction for it. There's more technical discussion on this. If you're a CPA group, I'd be giving you all the gory details, but you might get a $250,000 deduction, which means you don't have $250,000 worth of deductions coming up 18, 19, and 20. And you might also get some of the amounts, and maybe they're written off over a period of time. Well, why would you want to do it in 2017 versus 2018? Because in 2018 is when this 20% rule kicks in. You're already going to get a phantom deduction of 20%. So if I keep on taking depreciation that I could have wrapped up in a cost seg study in 2017, then the depreciation I'm getting, I'm not getting a 20% benefit. But if I did this in 2017 and I take my depreciation, there is nothing that impacts 2018 and beyond other than you have less depreciation, which now turns out to be good. So I would say if you have not done the cost seg studies, they're worthwhile looking at. They're worthwhile looking at for leasehold improvements that you may have done in the process. Some other rules on that I'll talk about later. These cost seg studies for 2017, they just simply have to be done and things attached to your return before the due date of your return. Now, some of those may come through on a K1. Those returns generally are due September. Your individual return is due October 15th. So if this sounds like it makes sense and you just want to explore it, you can usually get cost seg studies done for no fee because they're hoping you will hire them, the people who do this, for doing the cost seg study. So you can get that, and with some crunching of some numbers, you can make a good informed decision that if you have something, excuse me, if you have something that you might be able to do, this might be worthwhile. I can give you some reasons why a cost seg study might not be good in 2017. Sometimes these cost seg studies do such a great job, they actually drive into a taxable loss. And sometimes you lose your loss deduction. So, it's a maybe, it's a probable, but you still should do the calculations on that. Okay, slide 20, please. Okay, some other issues. I mentioned them before. This is all technical stuff, but what I'm trying to do is I haven't really given you all the pieces of this. I'm getting my 20% deduction raw. It's working, we're all great. But then you run into basis issue at risk, passive issues, loss of limitations, and use of aggregation elections. I'm just throwing those out. If you were again CPA, I'd go through that. But I'm just trying to not to impress you. I'm trying to make the impression upon you that there's a little bit more to this story than just doing a 20% calculation. It's called arranging your affairs in such a way that you can maximize the use of these deductions. By the way, is there anything illegal about trying to minimize your taxes? Is there anything wrong with legitimately arranging your affairs in such a way as to reduce your tax liability? Well, at one time, the IRS actually took on a taxpayer, and it went all the way at the Supreme Court. They said, bad, 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 you're trying to reduce your taxes. And the judge in the court was, I kid you not, his name was Judge Learned Hand. Sounds crazy. His name was Judge Learned Hand. And this goes back to the 30s. And his quote, which we quote often, it says, there is nothing sinister, there is nothing wrong with arranging affairs as to reduce your taxation. And he went so far as to say, not even a patriotic duty. I thought it was interesting. So that has been quoted many, many times. As long as you're legitimately with business concept, not just as a tax ploy, but with business concepts, there's nothing wrong with thinking these things through and trying to reduce your taxes. The only issue on the table is it worth it? Is it going to pay off? That's part of the analysis for you. Slide 21. Okay, by the way, I'm going to have to pick up the pace here a little bit because I see I'm getting close to my time limit. I get carried away on some of these things. Bonus depreciation, basically for assets acquired after 9/27/2017 to 2022. is 100%. It's interesting. Then go to 26, it goes to 22, and it scales back down. And now it's for new and used property. So let me go back to my cost segregation studies. And should they be done in 2017? Could you have gotten the impact of saying, I bought a used building and I want 100% deduction for my, quote, tangible property? If you bought the building after September 27th, the answer is yes. Unfortunately, this rule was if you bought the building before 27, being 26 and back, then it would only be done on new property. So had you constructed the building, clients were getting it. But if you bought a used building after that date range from 2017 to December 31st, 2017, there's a super opportunity here that you might want to take a look at. Okay, slide 22, please. There's also 179 depreciation that's been around for a while. The bonus does not have any dollar limitations. Here, this is limited. You can use eligible property from 500 to a million, and there's a phase out that starts at 2.5. No phase out on that bonus depreciation. They both apply to new or used. So some questions are, is which one would you want to take first? Probably won't make much difference in many cases. Let's look at slide 23. Okay, except qualified tangible personal property and qualified real property, improvements to non-residential property placed in service, which is roofs, heating, ventilation, fire protection, securities, can come under 179. They do not necessarily, and probably won't in much cases, come under the bonus depreciation. So there's a little bit of an angle here that 179 can still have a play with some exterior improvements. Let's look at 23 or 24, I'm sorry. Okay, I failed to mention that the leasehold, not leasehold, but the qualified improvements that are made to your property, that is an internal improvement. And if you make that improvement after the building's been put in service, meaning that maybe I'm the new tenant coming in after you left, and my deal with the landlord is I do the build outs on the whole thing, or the landlord does it, and we got everything, and then I put in all the improvements. The building has already been in service. That's where I get the tag off that with bonus depreciation, yes, you could take some good fast write-offs on the whole thing. If you had external improvements, that's where the 179, because qualified improvements now only covers internal improvements. And in fact, that particular item was a law change, I believe, back in 2015. So that makes the 179 used property, maybe for some external things, viable for us. Okay, now I'm switching to the business interest deduction. It applies only to a group of businesses where the gross receipts exceed $25 million. Now that is $25 million gross. It's all the related entities. They very clearly say affiliated. There's code sections as to what's affiliated. The affiliate rules for corporations have been around forever. They just tag into them. Sometimes you can break what's called attribution rules. So for clients over 25 million, you have to watch out for what's coming up. They, for some reason, I read some foundation article about this one time, and I finally just went on to something else because it was crazy. But there seems to be this thing that if you borrow too much money, you're getting an advantage over a business that is more equity based. That's as far as I can explain it. But basically, what it's going to do is going to disallow interest to the extent it exceeds 30% of your adjusted taxable income. Effectively, it means EBITDA, earnings before interest, taxes, depreciation, and amortization. You notice it's before interest and, in effect, depreciation. So for most people, where we're taking all these fancy, great write-offs, things like that, you're still going to, I think, in almost all cases, going to get your interest deduction, even if you are 25 million above. However, that concept's only good up until January 1st, 2022. Why they do that? Because this stuff could expire in 2026, but effectively after that, the depreciation is not allowed, basically creating a EBITDA. Not an EBITDA, I'm saying it wrong, but it's earnings before interest, taxes, and amortization. But the depreciation, you're gonna have to add that, you're gonna leave that subtracted. And I have gone through a few clients that check it, and yes, that will be a problem in 2022. So there's some long-term planning for how you're gonna bifurcating debt and things. You got a couple years to do it, but there's some thinking that needs to go into this. Let's look at page 25, or slide 25, please. Okay, business interest deductions to watch for 2022. The time depreciation used to reduce taxable income, thereby reducing this problem. It's on an affiliated basis. Some of the strategies are, can we get out of the affiliated basis on some of these things? Start thinking about your capital structures. You may want to shift loans into different entities that are more profitable and maybe not have loans or less profitable. Some clients have a master loan agreement and the proceeds can go almost anywhere, but as a practical matter, they book them in certain places, and maybe there's some issues on that we might want to think about. And then it goes back to, it applies to trader businesses. So now our triple net leases wouldn't be part of this issue, would it? What a quagmire this one's going to be. This might be an argument for our larger clients to leave your triple net leases and leave them intact, so that you just simply come up with the deferral arrangement to not pay the rent. And maybe if this is a problem, you start paying the rent in 2023, maybe even do it sooner than 2026. Interesting issues for clients in this situation. Okay, 26, please. Okay, net operating loss carry forwards. The law basically used to be able to carry them back 2 years and forward. Now you're limited to 80% of your future year income, and you're also limited to married filing joint, a $500,000 loss carry forward. So if you have a loss in 2017, depending how big it is, you might want to consider carrying it back if it works for you, as opposed to carrying it forward. 27. So the moral on this whole thing is, as I said before, don't wait till October, November to start thinking about this. Planning starts now, I would say no later than May, for the issues that you might need to do some restructuring to consider. All this restructuring ideas may not be, from a business point of view, worth the hassle, but you need to be thinking it through. You need robust software to figure this stuff out. You can never, it's a Rubik's Cube, and you just need to plan is what it boils down to. For our clients, we'll be identifying the opportunities, and after our last seminar, we will start approaching some of the clients shortly, and then we will probably approach the rest right after tax season, so we're not going to get much of a break, and we need to be talking and probably come up with a conclusion on strategies, but no later than May. For others who are not our clients, I'm glad you're listening in, but I would suggest that you start the discussion with your advisor. Most of them will have the tendency to say, let's do it after tax season. That is a natural tendency. I feel that way myself, but in some cases, some of these issues just can't wait. How are you going to handle leases and things like that? So having some discussion now to at least start getting some grasp on how you're going to do this is important. Okay, next slide. And again, don't wait. Start resolving these issues early. I just wanted to really emphasize that. Okay, next slide. And that wraps up for me. Let me tell you a little bit about the person who put all these beautiful slides together, and that is Kit here, office director, manager at our office here. So Kit has been running these slides for us, so I'm going to turn you back over to her, and we will wrap it up. But let me say thank you for attending.
Hey, thanks, Chuck, for that very informative presentation. If anyone happened to miss any part of this presentation, it will be posted to our website at www.rcthornton.com on the speaker series page. And just another reminder, we have one more webinar coming up on Thursday for the professional practices. And if anyone is interested in sponsoring one of these webinars for their associates or trade associations, please give us a call. We would love to work with you, and those are at no charge. Thank you, everyone. Have a great day, and we look forward to working with you soon.